Hey, it's Clay Trader at claytrader.com. In this video, I want to talk about a topic that is very popular. You see it being talked about all the time, and I do understand why. I totally get why this appears very attractive on the surface, why it appears like a no-brainer decision, and why it appears like, wow, that's about as easy money as it gets. I totally understand. However, it's not really as it seems, and that's what the point of this video is going to be. I'm going to talk about and give my thoughts, my logic, and I think back it up with some pretty good mathematical proof on why shorting penny stocks is just flat out stupid. So this is what I'm going to cover. Here's why I feel that shorting penny stocks is just not a very intelligent decision. So let's first go through a couple intro and context setups here. So first, maybe you're not sure what shorting is. Just in its very simplistic form, shorting means you make money when prices go down. So the logic here is that all penny stocks are junk, garbage, trash. Therefore, all will go down in price. Penny stocks are all pump and dumps, and they're all going to go down. So it's easy money. And not to mention, it's a pretty good sales pitch. I mean, it really does make sense. Hey, penny stocks are pump and dumps. They all go down. Short them. Yeah, that does sound good. Very good sales pitch. But that's the logic. And like I said, I understand. I get it. Yeah, penny stocks are trash. They're all going to go down. But it's really not that simple. That logic is way too simplistic and therefore completely wrong. It's wrong, and I'll explain why, and I'll give plenty of examples. So let's take a look at things from a logical standpoint that cannot be refuted, and that is just basic math and basic risk. That's all it boils down to, and that's what I'm going to use to really start to show, yeah, shorting penny stocks, that sounds good, but I don't know, in all practicality and all reality, is it really that good from a math and risk perspective? And also, I'm not saying that you can't make money from stocks going down in price, but there is a much better way than trying to short these penny stocks. So as traders, we got to get this out of the way first. If you're new, the sooner you learn this, the better. But traders, we are not in the business of making money. Yes, you read that correctly. That's not a typo. So you're probably thinking, well, then what are we in the business of? I thought I was here to make money. We're in the business of managing risk. And money is a byproduct of managing risk. If you manage risk over the long term, money's going to start to flow your way. That's what we're in the business of. If you want to call us kind of a glorified insurance agent, then that's what we are. But we are all about managing risk. Now, if you believe risk is something that doesn't really matter and it's all about making money, how much money can I make, then just save yourself some time. Turn this video off right now. I'm not going to be able to convince you of anything. If you don't think that risk matters, then you can go on your merry way and turn this off. But I'm going to tell you right now, you're not going to be a trader for very long. Your career is going to be very short. You may think I'm full of crap, but hey, go out there, trade. Don't worry about managing risk, and let me know how that turns out for you. But bottom line here, as traders and any professional trader, anybody in the trading business is going to tell you, I should say that actually knows what they're doing. At the end of the day, everything is about managing risk. So with risk at our forefront of our mind now, let's look at some basic math and then a risk versus reward relationship. So looking at a stock, when you go long, meaning you think the price is going to go up, you want to make money from the stock going up, what is the risk in that situation? Well, the risk is the stock drops to zero and you lose 100% of your position. In other words, you lose your entire amount. If you put in, $200 and you think the stock's going to go up, but it actually drops, it goes down to $0, okay, you lost $200. But what's the reward? The reward is unlimited because a stock can go up as high as it wants, right? A stock, there is no, it can go from 100 to 200 to 300, so on and so forth. Point being, the reward is unlimited because prices can go as high as they want. I mean, they can just fly and keep on going. There's nothing that is restricting them. However, now let's look about going short, meaning I want to try to make money from prices going down. Well, in this case, our risk is what? Unlimited. It is unlimited. Why is that? Because, well, for the same reasons. A stock can keep going up and keep going up. And when you're trying to make money from the stock going down, but it's going up, you are losing money. And as we just discussed, because a price can go up and up and up, your risk is unlimited. So you can lose your entire amount plus even more. Now, what's the reward? What's the best you can do going short? Well, what were we saying earlier? The lowest a price can go is what? A zero, right? So your possible reward is 99.99%. And this is all under assumption that you're playing it perfectly. So if you play a stock perfectly, the best case scenario for you is going to be from the short side, making 99.99%. However, the worst case scenario is what? It could get very, very ugly because a stock price can just keep going up and up and up. So hopefully you're looking at this and you say, wow, that seems a bit lopsided. Well, of course it does. Going long, meaning you're going to try to make money from prices going up, you're risking 100%, which is your entire amount, okay? But at least it's not your entire amount plus more, but your reward is unlimited. Here, going short, trying to make money from prices going down, you're risking not only your entire amount, plus, I mean, this is crucial. That little plus sign is huge to understand what sort of risk is going on here, plus even more. Yet you're risking all this for maybe 99.99%. And again, this assumes that you play it perfectly. So, if you need to stare and kind of look at this table a little bit more, please do that. But, really understand just how lopsided this is. So I want to do some quick clarifying and then just ask if you can relate to something. First clarification, as far as penny stocks are concerned, I'm just defining that as any stock, and it could very well be over $1, but historically it has very low volume. So there's not much volume, and then boom, all of a sudden volume hits it. And many times these are, have a lower float, which just changes the dynamics that much more. But main thing here is these are not stocks that have, millions and millions of shares traded every day. I mean, if you're looking at a chart and it's a $3 stock, but every single day for the past 10 years, it's done at least let's say 20 million shares or 30 million shares. Well, that's a little different. I'm talking about stocks that historically really don't have anything, and then boom, volume comes surging in. Now, also, can you relate to this? So you see a stock moving and you want it, and you say, look how much that price is going up. I want to get in because I think it's going to go up some more. But every time you try and buy, the price moves up and you don't get any shares. It's very hard to get in. If you've been around long enough and you've traded penny stocks or these smaller type stocks, then you know what I'm talking about. It's going up, you're trying to get in, you're putting in the price higher than what the current price even is, and you're still struggling to get in. It's a very frustrating thing because you just see the price keeps going up, but you cannot get in. Very frustrating. So at that point, you have three choices. You can enter in new order at a higher price and then try again. And maybe you'll have to try again. Or you can just say, you know what, I'm going to wait and see if the price pulls back and then try to buy. Or you can just walk away and look for a new trade. Keep this in mind because this is going to become very important here in a little bit. So why don't I short penny stocks? Why is shorting penny stocks stupid? Well, we've been over that all. But now let's take a look at the 3 L's. And when you see this, hopefully it kind of, okay, wow, that's actually kind of scary. And I want to be upfront. Does this happen all the time, every single time? It does not. However, all it takes is that one time. All it takes is that one time where your risk gets blown out of proportion and your account is going to experience what you see here in this picture. It just takes once. So for our first L, we're going to look at LEXG. Again, LEXG. And example here, what am I talking about? Well, notice, no volume, no volume, no volume. And then all of a sudden volume starts to come in and it goes from basically down here at 10 cents up as high as $1. So, multiple hundreds of percents right away. And you see this and say, wow, this thing is a pump and dump. It's a filthy penny stock. It's going to go down. So maybe you don't short right away, but let's just kind of see how things play out. So you have a couple sideways days and you say, all right, well, it's going up. It's going up. You're like, well, I want to look for something. And then you see that and you're like, all right, wow, look, it's gone up from basically 10 cents up to $1.70. Look at all this volume. It's time to short. And then you see that, you're like, aha, see, the dump is on, here it comes. Or maybe you wait and you want to see some weakness first. So you see some weakness and then you short here. Remember, what's the best you can do? The best you can do is 99.9%. Let's just see how things continue to unfold. So it goes sideways a little bit, starts to head back up. So the people that are shorting are probably a little nervous. And then that happens. Now it's up to $1.92. Now it's up to $2.47. Again, what was the best you could do? 99.9%. And now look how much it's gone up. So now maybe some people see that and they're like, all right, well, there's the weakness. So maybe they got shorted here. Like, the dump is upon us. Here comes the dump. And then this happens. It recovers. And then again, on this day when the price was falling, because remember, this would all be one red candle, maybe people hopped in right here. I don't know, the point being, you're getting short because your rationale is it's a penny stock, it's a pump and dump. All these pump and dumps go down. They're all going to crash. And especially, when you think, well, geez, not that long ago, it was down here below 50 cents, and now it's up here at $2.63. This thing's going to get hammered. It's going to dump. And then all of a sudden, that happens. And now all of a sudden, it's up at $3.90. And the key thing here is that remember what I said about can you relate to wanting to get into stocks that all of a sudden get volume and it's very difficult? Well, remember, if you short, that means you need to, in order to get out of the position, you need to buy. So if you're trying to buy and this action just keeps on happening, how painful is that? And then all of a sudden it's up here at $5.50. Maybe you're trying to get out, but it's being very, very difficult to get out. And then look at that, this next day. Remember, where did this one start when we started this journey? Back here around $1. Actually, it started below 50 cents. Now all of a sudden we're up here. So maybe you're thinking, oh, well, surely. I mean, this thing is just way out of control. And then look at that. Next day, it explodes that much more. And then finally right there is the dump. And then everybody focuses on this and says, see, penny stocks, they're all pump and dumps. Here's where all the money's made. Well, yeah, all the money could have been made here. But still, you're not even playing it perfectly. Remember, this has to go down to 0 in order to make 99.9%. Keep that number in mind. This is a great looking move. Yeah, you can make good money from it. But in order to get even close to 99.9%, it's got to drop still, $3.70. But again, everybody will focus on this. But what about all this? What about shorting here, smoked? Shorting here, smoked. And remember, you may think, well, I'm only going to risk 10 cents. Well, what happens when it hits your 10 cents and then you try to get out? Uh-oh. Okay, well, now I got to try to get out. Now all of a sudden your risk is 20 cents, 30 cents, 40 cents because you can't get out. If you don't think that's real, then just try to short one of these and let me know how easy it is to get out when these sorts of upwards moves are happening. So again, yeah, everybody's going to focus on this. See, they're all pump and dumps. Easy money here, easy money. Well, yeah, and then they neglect all this time when all these shorts were getting crushed all the way here. And again, like I said, even at this move, remember, what's your risk? Your risk is a huge amount, yet you're possibly going to make, if you played this perfectly, what is that, about a 60% move or something like that in one day? Yeah, 60% is good, but like I said, there's a much better way, and you don't have to risk. You don't have to go through an unlimited risk. So this is just one example. I mean, a huge move and just, crushed a lot of people. So literally from basically 50 cents up to a high of basically $10.50. So, yeah. Sure, everybody can focus on that one nasty day, but what about all those huge bullish days where it just kept going up and up and up? And not to mention all sorts of sucker days. What do I mean by sucker? Well, this downward move suckered in shorts. That move suckered in shorts. This little thing here would have suckered in shorts. So a lot of things where it looked like it was collapsing, but then all of a sudden it just came ripping back. Okay, our next L, L-O-T-E. L-O-T-E. So again, notice down here, I'm not talking about stocks that do millions upon millions of shares all the time. Nothing. Then all of a sudden volume starts to creep up and then you get this huge massive VAR. So we're right down here around 25 cents. 25 cents is when this starts. This is just a pump and dump. It's a piece of trash. I agree. This is a pump and dump piece of trash. But the point being is, when is actually the top going to happen? Because if you don't short at the right spot, you could experience a lot of pain because, remember, these are there's not much volume, and you could try to be getting out. You could say, just buy. I want to buy to cover to get out. But you can't get out because, when these moves get going, they get going quick. So it starts to move, 25 cents. All right, now it's up to 30. Volume staying strong. Right here, okay, here's a possible top point. And then it just keeps going on. And let's just go through it. You get the point of what I'm trying to get at right now. Remember, start at 25 cents. So here's a sucker move. At one point, this, it looked like it was collapsing. Then all of a sudden, it bounced all the way back up. And then now we're up to 45 cents. Some more little kind of sucker movement here, making, the top's in. It's getting ready to roll back over. Another look at that. Price fell down, so that price suckered in some more shorts. Again there. So just going sideways, all this thing's getting ready to roll over. This thing's history. It's done. And then all of a sudden, huge candle here. Now we're up to 56 cents. Okay, some more sucker. Okay, yep, this is over. You could see people thinking that. And now look at this thing. 70 cents. Now look at it. 90 cents. Remember, it started down at 26 cents. And then here's the dump. Guaranteed. Look at all that volume. Shorts were getting in. Shorts were chasing. Shorts getting in. And then look what happens the next day. Pure cruelty. Huge move. Now we're at $1.10. Now, if you time this right, could you have made some money here? Yeah. But did you make anywhere close to, 99.9%? Of course you didn't. You're risking a lot to make potentially, 30, 40, 50% maybe if you play it right and are just playing it perfectly. Yet you're risking, trust me, people were shorting down here. No doubt about it. People were getting in, shorting. Yeah, it's a pump and dump. This thing's going back to 10 cents. I'm getting in. And then all of a sudden it turns around and rips on them. Next day, now it's up to $1.50. Next day, look how high it goes there, 280. So you could see people, up. Here's the dump. I'm hopping in. Up, see, it's getting ready to roll over. Getting ready to roll over for sure. And then it pulls back some more. And then notice what happens. Now all of a sudden it's at $4.50. So again, price suckered in some shorts here, and it bounced back up. And just to get the rest of the story, check that out. Up as high as $6.25. Remember, this started down at 25 cents. And then there was finally the dump. And then, from there, yeah, it's a piece of garbage. It's a pump and dump. It's going to go down. Absolutely. But when is it going to go down? You sure are risking a lot to gain, yeah, maybe 50%, maybe 60%. But 99.9% is not happening. I mean, that assumes that it goes down to zero and you play it perfectly. But that's not going to happen. But you're risking a lot when you don't know, is one of these moves existing? I think that's very scary, and it just doesn't make much mathematical sense. And then for our third L, we're going to look at LAKE. This was an Ebola stock, and when that was all in the headlines, this stuff started to rip and roar. But again, not much volume. And then all of a sudden, when those headlines started to hit, okay, volume starts getting. And again, give me a break. Is this really gonna take off? It's just one of those things where a lot of people thought this is all overblown, and yeah, it was way overblown. However, when exactly is it going to be officially overblown? Well, we had this thing here where a big volume and then a big candle comes. So I'm just going to kind of speed through it. You're getting what I'm trying to get at here. So we're thinking right down here around $8 to $8.50. And you're thinking, okay, well, this is a higher price stock. So, and then all of a sudden we're at 10. Now we're at 11.50. Now we're at a high of almost 20. Now we're at a high of 22. Now we're at a high of 29. And you can better, I know somebody that shorted this and got crushed because they just, they were trying to play the headlines, and then more headlines came out, and this thing just kept going up and literally crushed them. I mean, it wiped out their account. And you can see right here, okay, finally, things overblown and reality return. It started to drop back. But yeah, it's easy to focus on this and see, you just short these overblown, these overbloated pigs. Well, to me, it looked pretty overbloated right here. I mean, from 8 up to 19, that already looked overbloated, yet it still went up that much more. So hindsight's very easy to say, focus on that. That's what we're looking for. Yeah, well, you also have the risk of getting crushed on the short side as it goes up. But here's the good part. There is a better way, and it's so much better. If you want to make money from prices going down, excellent. It's a great way to go about things, but there is such a better way to do it from a risk versus reward standpoint. That's what I want to get across. From a risk versus reward standpoint, there is such a better way compared to trying to short these penny stocks, these low, historic volume stocks that can really explode against you. And now look at this risk profile. So I'll just, spill the beans. They're called options. Maybe you've heard of them. Maybe you think, oh, wow, options are complicated. Trust me, they're not nearly as complicated as some people. Can they be complicated? Absolutely. Can they be very complex? Yes. But do they have to be? No, not at all. So let's look at the risk versus reward profile in terms of options. And hopefully you're looking at this and saying, does anything seem lopsided? Nope. So how is this, how is it different? Well, let's look. If you think a price is going to go up using options, your risk is 100%. Again, if you're wrong, you could lose your entire amount. But that's how it is in stocks too. If you are right though, and the price goes up, your reward is unlimited. I mean, a price can go up as high as it wants. Going short. So if you think a price is going to go down, what is your risk? Well, with options, it's 100%, just like going long. If you need to go back and look at that other slide, hopefully you see the big difference there. But huge difference, just your entire amount. If the price goes up and up, well, the most you can lose is the amount you put in, not a entire amount plus more. But your reward, unlimited. Now to an extent, because yes, the price can eventually hit zero, but if you nail an option and the price goes to zero on the stock, I mean, you're looking at thousands of percents that you've made. So I'm just going to leave it at unlimited, but technically speaking, not unlimited. But if you get anywhere close to, where a stock actually goes to zero, then your options are going to have massively increased. And I'm not exaggerating when I say they'll have gone up thousands upon thousands of percents. So how is this all possible? Well, we've already got options. So let's look at a couple examples of options. And hopefully you're saying, wow, this is a much better risk versus reward profile. So in our case study one, this is an actual trade. One of my students sent it to me, their screenshot. So what they did was, they saw, and this is LinkedIn, so this is a big board company, and they saw, I actually alerted this in the chat room too, but anyways, we're talking about, hey, it's looking like this big move has happened. So hey, doesn't that look kind of familiar, almost like a pump? Well, I think it might be heading down. So this person went and bought, and I'm not going to explain how they work, just understand, the bear, kind of outside looking in, but they bought a quote-unquote penny stock because options, that you can pick them up for 12 cents if you want. But they bought a penny stock at 12 cents, and they thought, I think the price is going to go down. So the price did go down, and in less than 10 minutes, 275%. Now remember, wait a minute. From stocks, the best you can do if it goes down is what? 99.9%, and that's if it drops all the way down to $0. However, with options, if you're right and the price does go down, you can make much more than 99.9%. Case in point right here. So in this span of about 9 minutes, they bought at 12 cents, and then, right here, they sold for 45 cents. So the quote-unquote penny stock went from 12 cents to 45 cents because of this move in the LinkedIn chart. And just so you're I can't afford LinkedIn. Well, just understand that options, to get involved, if you wanted to, pick up a share here, it would have cost you literally $12. Now, you would have probably caught more, or you would have put more into it. But point being, $12. That's the absolute minimum you would have needed to get involved in this, which is another power of options, is you can have small accounts and get involved. And like I said, went up to 45 cents. This person obviously sold too soon because the price ultimately drifted down here. So the options went up at least probably 500%, because like I said, the price just kept on dropping, which means this number here would have kept going up and up and up. Point being, again, just to reiterate, from a stock, the best you're going to do is 99.9% because it's got to go to zero. Whereas with an option, not only is your risk measured, because if it would have bounced back up, well, the most they would have lost is whatever they put in. They're not going to lose unlimited with options. You cannot lose unlimited with options because you can only lose what you put in. But so very favorable risk, and yet upside reward of, in this case, 275%, but they would have had more had they held. But point being, I hope you see the differences here. Now, this is just an example from the chat room that I wanted to, just kind of highlight here. But at one point, I alerted GoPro that, hey, this level here was key. And it was one of those things where at the time, the options, you could have gotten an option for, or, quote unquote, penny stock. You could have gotten one for $1.40. So the minimum amount, I can't afford options. Yeah, you can, because at this, the minimum amount needed would have been $140. So you could have gotten involved at for $140, picked up the quote unquote penny stock for $1.40, and then you can see the price did indeed go down. So when it went down, remember, the best you can do at a stock, 99.9%. In this case, by dropping from here to here over a span of about an hour, the option went from $1.40. The penny stock went from $1.40 up to $3.90. That was an opportunity window of 179%. Now, am I saying you would have gotten 179%? Well, you'd have to play it pretty perfectly. But let's just say you got, 100%. Wait a second, you can't even. 100% was just basically, that's realistic. But 100% is never going to happen by shorting a stock, because I've gone over it a million times, but I'm trying to drive that home, because the best you can do on shorting stock is 99.9%. Yet, when this price fell, because you're using options, you had an opportunity window of much higher than 100%. So another example of prices falling, yet the reward being much more than a 99.9%. And again, the risk here would have been, let's say you bought one, and you put in $140, that would have been your risk. The price could have skyrocketed up. It could have done one of those 3L examples where it just kept going up and up and up, but it wouldn't matter. The most you would lose is $140, and that's it. For the final case study, I'm just going to go over a blog post that I wrote, highlighting all this out. But again, at this point in time, this was on Netflix. So you're saying, wow, $338 a share, I can't afford that. Well, just understand that options work different. You don't need a huge amounts of money. But anyways, I alerted this, just saying, you know what, keep an eye on that level there. So we'll speed up. And at the time when I gave that alert, I actually took some screenshots just to prove the point. You could have gotten in at, we'll call it $1.59. So you could have gotten a penny stock, quote unquote, for $1.59. Again, the minimum amount you would have needed was $159. That may not make sense, but that's not I'm not trying to explain options. I just want to show how options work compared to trying to short penny stocks. So you thought the price of Netflix was going to go down. You could have gotten involved in this trade for $159. So then you can see that Netflix did indeed go down. It dropped right around $5 or so in about 2.5 hours. So when Netflix dropped $5, remember, it didn't go down to 0 or anything, but in that span, you can see that the options, remember, you got in at 159. This is what the level 2s look like on the options. Over that span, the options then look like right here. So you could have for sure gotten out for $2.55. So from $1.59 up to $2.55, that would have been a gain of 60%. Now, not as huge as the other ones, but I want to keep things realistic and say, options aren't going to give you hundreds of percents every single time. But hey, still, a gain of 60% where your risk, is always very well under control, just due to the nature of options. I think that's pretty solid. So just yet another example here of a stock going down, yet you're not having to have unlimited risk. And then just to bring everything, in conclusion here, just keep in mind the risk versus reward profiles. When you're trying to short a penny stock that doesn't have much volume, and yeah, sure, you could catch the top. Going long, 100% risk, unlimited, okay, that's fine. But our whole thing is going short. Well, remember, with the stock, your risk is unlimited. You could lose the entire amount plus have to give your broker more money if it really just crushes you. Yet you're risking all this to make possibly 99.99%. Whereas with options, let's just focus on the going short. Like I've been trying to drill into your head. Your risk is whatever you put in. For that one example, if you put in $140, then the most you can lose is $140. For the other example, if you put in $159, the most you can lose is $159. And yet, in both of those cases, as you saw, unlimited reward. I mean, some of those, went down and they weren't even close to 0, yet the options had already gone up over 100%. So that's what I mean. If a stock were to ever go down to 0 and you're holding options, you're looking at thousands and thousands of percent. So point being, massive difference between this and this. When this video is over, if you want to pause it right now, just stare. Just stare at this. This is the risk versus reward profile, and it is what it is. I think it's quite a no-brainer when you look at the basic math and understand that as traders, risk is what we're all about. We have to manage it, and using options compared to trying to short these low-volume penny stocks, it just really doesn't make any sense. So if there are any other questions or anything, please leave your comments below. I'd love to hear from you. Please click the like button if you found this helpful. And if you have any other questions, you can find me at claytrader.com. And I'd be happy to answer any questions or help you maybe point you in the right direction for options. But disclaimer, I will probably point you right to my options course. And that's just I think it's a very easy way to learn options. And it's one of those things where I think it's hopefully you'll stop wasting your money trying to search around for a broker that's going to let you short penny stocks. You're going to quit wasting your time with the hassle. Now I got to find shares to short. Why go through all that hassle when there's something such as options out there that not only gives you a better risk profile, but it gives you a better reward profile? To me, that's a no-brainer. Thanks for watching. Have a good one.